Good day, investors. On Wednesday, January 28th Eastern Time, U.S. stocks traded mixed and closed with fluctuations, showing a pattern of structural divergence. The Federal Reserve kept interest rates unchanged as expected, and Powell's speech sent cautiously hawkish signals. Coupled with rising government shutdown risks, market sentiment turned prudent. However, the semiconductor sector surged, driven by strong earnings, and tech stocks were mixed, becoming the key highlight of the session. Key closing data showed volatile divergence. The Dow Jones Industrial Average edged down 32.17 points, or 0.07%, to settle at 48,971.24, fluctuating lower due to government shutdown concerns. The Nasdaq Composite rose 89.45 points, or 0.38%, to 23,906.55, supported mainly by the semiconductor sector. The S&P 500 gained 14.22 points, or 0.20%, to 6,992.82, approaching the 7,000 mark. Trading was moderate, with capital flowing into high-prosperity growth sectors and partial fermentation of safe haven sentiment. The core driver of the day's trend came from the Fed's decision. The Fed's FOMC meeting voted 10-2 to keep the federal funds rate unchanged in the range of 3.50% to 3.75%, in line with widespread market expectations, with dissenters advocating a 25 basis point cut. In a press conference, Powell emphasized the Fed's independence, suggesting the next Fed chair draw a line with politics. He also stated that inflation has peaked but remains a concern. The timing and pace of rate cuts this year have not been determined. The labor market is stabilizing, and the foundation for economic growth is solid. Sectors showed a clear distinction between strong and weak trend. The semiconductor sector saw a broad rally. Texas Instruments surged over 7% after reporting the fourth quarter revenue of $4.42 billion, which is an increase of 10% year over year, and full-year revenue up 13% year over year, beating market expectations. ASML rose nearly 2% intraday, supported by strong fourth-quarter EUV lithography machine orders, with unfulfilled orders reaching €38.8 billion, despite announcing plans to cut 1,700 jobs. Tech stocks were mixed. Microsoft and Meta traded sideways intraday ahead of their after-hours earnings, while Intel stopped falling and rose 0.83% after 2 consecutive days of sharp declines. In other sectors, consumer stocks performed well. Starbucks rose 2.35%, with its global same-store sales increasing 4% in the first quarter of fiscal year 2026, and same-store sales in China surging 8%, far exceeding market expectations, driving the chain catering sector to edge higher. The healthcare sector continued its downward trend, with United Health Group falling another 3.12%. Dragged by weak earnings and industry policy pressures, sector sentiment remained sluggish. The energy sector fluctuated slightly higher by 0.45%, supported by tense geopolitical situations in the Middle East, with crude oil prices rebounding slightly. Chevron and ExxonMobil both gained over 0.8%. Most Chinese concept stocks declined, with the Nasdaq Golden Dragon China Index down 0.97%, and only a handful of leading stocks rose slightly against the trend. On the macro front, the risk of a government shutdown remains the top hidden danger. With only 3 days left until the January 31st deadline, bipartisan negotiations have reached a stalemate. House Republicans insist on linking immigration policy reforms to the Department of Homeland Security funding bill, which Democrats firmly oppose. Moreover, the House has adjourned until January 29th, leaving less and less time for negotiations. If no consensus is reached, multiple federal agencies will face funding disruptions, further impacting market sentiment. In addition, the U.S. pending home sales index fell 1.2% month-on-month in December, below expectations, reflecting a weak recovery in the real estate market. Coupled with the sluggish consumer confidence index, expectations of a slowdown in economic recovery were strengthened. Looking ahead to Thursday, January 29th Eastern Time, markets will focus on earnings reports from tech giants such as Microsoft and Meta, while closely monitoring progress in government shutdown negotiations and comments from Federal Reserve officials. The market is likely to continue its volatile and divergent pattern. Key watch points include: first, the earnings performance of tech giants, especially the revenue growth rate of AI businesses, which will directly affect the trend of the tech sector. Second, whether there is a breakthrough in bipartisan negotiations to avoid sentiment-driven volatility. Third, the trends of crude oil and gold prices. Amid rising geopolitical risks, the flow of safe haven funds may reshape the sector pattern. Strategically, it is recommended to focus on opportunities in the semiconductor sector and earnings reports of tech giants, deploying into growth targets with strong performance certainty on dips. At the same time, allocate gold stocks and energy stocks to hedge geopolitical and policy risks, and avoid weak sectors such as healthcare and real estate. Short-term market sentiment is dominated by multiple variables. It is necessary to control positions strictly and gradually increase positions after earnings and policy signals are clear.